Hey guys, welcome back to another episode of 5 Minute Morning. Thanks for tuning in with me on this Friday as we talk about a current event that is happening, or I guess should say just happened not that long ago. I was actually on Newsmax talking about this in an interview because it's not every day that we hear reports that are government releases that are incorrect. And they admitted. And in recent announcements, the Bureau of Labor Statistics, also known as BLS, released a substantial revision to the job numbers report, which revealed over 1,800,000 jobs were fewer than they initially reported. And this revision marks the second largest correction since the 2008 financial crisis, which raised concerns about the accuracy and reliability of economic data. I mean, obviously, we already aren't sure if we can trust politicians, but now we can't trust the numbers that they give us. And as I pointed out on the episode with my interview with the host and another financial analyst, we talked about this pattern of revisions and early announcements, just like in 2022 when the BLS prematurely released the numbers early, which gave traders an advantage in the stock market. This isn't just a technical error. It truly calls into question the credibility and the reliability of the numbers that we rely on to gauge the health of our economy. So why did this happen and how bad is it really? According to so many people, it could be that the current administration is attempting to maintain a very certain specific narrative about the economy's health, especially as inflation climbs and we're going into an election cycle. And despite reports suggesting that inflation is cooling, the reality on the ground for most Americans is quite different. Like, I don't know anyone that hasn't felt the weight of this economy as costs are rising out of control. Now, they're saying that inflation is slowing, but that doesn't mean that it's driving down costs of goods right away. It just means that costs aren't rising as quickly as they have been. And somehow this lag is going to then create some sort of positive economic data that might not truly reflect the struggles that everyday Americans are facing. And this job market correction has massive implications. I mean, they're coming out now and saying that it's almost 1 million off. I guarantee you, I would bet that by 2025, we are going to see this number climb over 1 million because it is not very often that they're going to come out this quickly and say, hey, we made a mistake. So this could be even worse as we get into the next several months. And many businesses and entrepreneurs have already seen a slowdown in the job market because of business and the economic standpoint of where everything is in the cycle. And employees across various industries have all reported that they feel the pinch as well. There's not a lot of opportunity for promotion and elevation, and people that are leaving their jobs are a lot of lateral moves. So it's a scary time for a lot of people. And what's even worse is that since this isn't the official revision, I have a feeling that that will be coming in February, and it could be an even bleaker picture than what they're painting right now, particularly in manufacturing, a sector that is already in a deficit. Manufacturing jobs, which are crucial to our country, to middle and working class Americans, are already being lost at an alarming rate. And this trend could continue to accelerate if the conditions deteriorate. You know, one of the most heated debates in economic policy right now is the proposed corporate tax rate increases. The current administration is proposing an increase to the corporate tax rate from 21 to 28%. And obviously that is huge concerns for the impact of entrepreneurs, American businesses, and workers, because this move could very well lead more companies to relocate their headquarters abroad, particularly to like Ireland, which obviously it's not like everyone's going to Ireland for the rain. It's because the corporate tax rate is significantly lower at 12.5%. And when American companies move their operations overseas, they're not just taking their revenue and the tax dollars and profit with them. They take massive amounts of jobs. That's why the implication on taxes and how it relates to our economy and to companies is so important, because it can lead to further job loss in manufacturing and in other sectors, which will compound issues that we already have, including this labor market number revision. They are proposing 44.6% tax on capital gains and a 25% minimum tax on unrealized gains greater than $100 million. That alone is so difficult. If they're going to tax unrealized gains, meaning if you have a property that increases or a business that increases, but you haven't actually taken that amount, are they also going to tax you for the increase in equity that you have in your home, even though you haven't sold it? Are they going to tax you on the potential promotion that you may get and the earned income bump that you may get? Like, taxing unrealized gains is unheard of. And rates like this, where you're taxing capital gains at such high amount, is going to drive revenue in companies right out of our country, which is the opposite of what we need. For business owners and investors, these tax hikes represent a significant financial burden, one that really would discourage the kind of risk-taking and innovation that it takes to drive economic growth. And to fully understand the potential consequences that things like these policies can have, it's really important to look back historically. Under President Reagan and later under President Trump, we know that lower corporate tax rates are linked to increased economic activity. When tax rates are lowered, Dr. Art Laffer did a lot of work on this. We know that when they're between 15 to 17%, businesses have more capital to reinvest in growth, which creates more jobs and higher wages. And when the U.S. has lowered corporate tax rates in the past, the country actually collected more tax revenue, which is contrary to the belief that lower taxes mean less government income. And this isn't political. It's literally, when we look back at decades and decades of historical data, we can see where the economies were booming, where they weren't doing so well, what the corporate tax rates were at that time, what was going on in inflation in the market. It's not a political talking point. I'm not trying to buy your vote. I'm not running for anything. It's just the reality of our labor market, inflation rates, and the impact of tax increases. And as we get closer to the election, the stock market is probably going to be pretty volatile. That reflects investor uncertainty and potential direction of economic policy. And for businesses and investors, navigating this landscape is going to require you to really consider the short-term signals that we're seeing and any long-term implications that these policies can bring. For businesses, employees, investors, the upcoming months are going to be so critical. Stay informed, be prepared for possible changes. Make sure that you are building the Brinks truck of your life so that regardless what economic conditions come, that you will be weathered for any storms or downturns. I will keep my eye on these developments. I'm in the media every single week. I think I've been in 5 times in the last 6 days. So I will continue to provide you with insight of what it means to you and your business, how you can understand this better so that you can make better informed decisions. Okay, guys, that's all for today's episode. Thanks so much for tuning in to the 5-Minute Morning. And while we're talking about fives, if you would please leave us a 5-star review on Apple, we would all be so grateful.